Hello dear viewers, welcome to this video. In this video, we'll continue working on our financial modeling. In our video series, video number 45, we discussed about this issue, how to switch the scenario here and how to see the selected cases, and then by using selected cases, how to calculate the forecasted amount for our future period. So as I have shown you in our previous video, video number 45, when we change here the scenario, for example, from best case to base case, it changes our forecasted amount because the selected case here changes. So now we are here in base case, which is 2% revenue growth. So if I change base case to best case, you see here it changes to best case, which is 3%. At the same time, when the selected case here changes, the forecasted amount for our future period changes here, as you see. And we calculated this future period forecasted amount for revenue, COGS, and operating expenses. As I promised, we will be working on D&A, depreciation and amortization, interest expense, and taxes. But in this video, before we going to these items, let's uh, calculate uh, historical required values for balance sheet projection. For balance sheet projection, the drivers for balance sheet forecasting are DSO, DPO, DIO, other assets as percentage of revenue, other liabilities as percentage of revenue. So these are the main drivers of balance sheet projection or balance sheet uh, amount forecasting. So before coming to see these items uh, briefly, let's set a forecast period for balance sheet. I will start typing here uh, forecast, forecast, and then I will copy paste this format to my future uh, uh, forecast here. It will be for 5 years. So I copy paste this format to all the years to be projected. So I copy paste only format this in this case. Here we go. Looks good. And then let me merge and make this forecast at the center here. Merge in the center, you see. And then let me change a little bit the font size, making it bold and changing the color. If you need, you can change maybe the background color also. I think it looks good now. And we can also copy paste the date to be projected here, and we can adjust accordingly. So what I'm going to do is I copy paste values in this case, and I change year to 2022, and the same way I can copy these values to all the years, and then I change the years only. I come here, I change this to 2024, and this is 2025, and this is 2026, and this is for 2020. Okay, 2021. Oh, I made a mistake. This should be 2023. 23. This is 2024, and this is 2025, and this is 2026. So these are our future uh, forecasting period. We will be forecasting our balance sheet for these 5 years. Interesting. Now the forecast period adjustment looks good. I can also copy paste this formula to all the years here. I copy paste only formulas in this case, only formulas. Great. So this one also copy and paste special only formulas. So yeah, in the normal balance sheet, as I have said in our previous video, you may need to go for like putting current asset first, like cash, account receivable, inventory, and then you go for a long-term assets or fixed assets like PnE and other assets. But for our work, for our modeling, as I have said in our previous video, this is okay for a modeling work. Now let's add more rows, blank rows here for our drivers to calculate our drivers. Uh, I need more blank rows here. Here we go. I think this is enough. I start from here. First, DSO. Don't worry, we'll discuss what is all about DSO, DPO, and DIO, and other assets as percentage of revenue, and other liabilities as percentage of revenue. Great. So these are our drivers for balance sheet. As I said, let's uh, make them a little gray, separate it from the other space. Interesting. Now what we are going to do is that let's see what is DSO, DPO, DIO. I give you a brief explanation on these terms for someone who has no strong accounting and finance background. These terms are very important. Otherwise, we cannot directly go for projecting our future or projected balance sheet. Let's see these terms. Um, Here we go. DSO stands for Days Sales Outstanding. DPO stands for Days Payable Outstanding. And DIO stands for Days Inventory Outstanding. Days Sales Outstanding, coming with its definition, is simply the number of days on average it takes a company to collect its receivables from its customers. So, especially when a company makes sale on credit, it has to collect back the money, right? So the number of days it takes a company to collect back that credit sales is what we call days sales outstanding. That's average actually, average number of days. Um, it simply measures the average number of days for a company to collect payment after a sale. So its formula is simply we divide average account receivable in a given period by total sales or revenue, and then we multiply by 365. It's very simple and easy to understand, I think. Coming to days payable outstanding, this but the definition for days payable outstanding is simply the number of days on average it takes a company to pay back its payables. How many days it will take a company to pay to its creditors or suppliers. So that's actually the average number of days that uh, a company takes to pay its invoices. And coming to this formula, we simply divide the average account payables by cost of goods sold. In days uh, sales outstanding case, we took what? Total sales. But in the case of DPO, we take COGS. That's most important thing to know. And let's see days inventory outstanding, DIO. It's simply the numbers of days on average it takes a company to turn its inventory into sales. So in how many days on average a company changes its inventory or turns its inventory into sales, or sells out its inventory, how many days it takes, or for how many days the inventory stays in stores before it goes out for sale. All right, so its formula is simply dividing the average inventory by COGS and multiplying 365. So both DIO and the DPO uses COGS, whereas DSO uses sales, credit sales. Interesting. So that's very important point to note. Having said this, let's go to calculate the historical the historical the historical values for these all items here. So we simply now go to DSO. If I click on equal sign and then I divide trade receivable here, which is equivalent to account receivable, I divide this by the total revenue in 2019. So the total revenue is not here, it is in PnL sheet, in income statement sheet, which is here, and then I multiply the division result by 365. So don't be confused. We took trade receivable from balance sheet or account receivable from balance sheet, and we divided it by the revenue in that given year, 2019, and then we multiplied it by 365, which is the number of days in a year. It can be 360. So now I copy paste this formula to other years, to other historical years here. And then we may need to have fewer decimal digits here. Yeah. So this means that it takes it takes um, 19 days, 19 days for a company to collect its receivables from customers. 19 days on average. Now let's calculate uh, the DPO. DPO. Hope you remember the formula which I've shown you. To calculate DPO, we take trade payables or account payable, which is here, and then we divide it by COGS. Again, COGS is in income statement or in PnL statement. For 2019, I take, and then we multiply in the same way by 365. Here we go. So yeah, we may need to have only number of days only. So I simply copy paste this to the other years, historical years here, and it's negative sign. This is something uncommon. Days cannot be negative, so I have to make sure that I change this negative by uh, multiplying it by -1. That's it. So let's also calculate DIO, which is days inventory outstanding. For this, in the formula we have seen that we have inventory here, and we divide inventory by COGS, which is in the PnL statement. It's here, and then we multiply it by 365 or 360. So simply drag to the right, and don't forget to multiply this by -1 so that uh, the days should be positive. There is no negative days. Yes, decimals, we may not need decimals even in this case. We just we're only interested in the number of days, so that's why it says days sales outstanding, days payable outstanding. So that's all, that's enough. So in 2019, on average, it takes 19 days to collect a receivable. But on 2022, is it 2021? Yes, on 2021, it takes 20 days to collect. That's averagely takes 20 days to collect it is a receivable. Yeah. So in this way, we can uh, interpret the result. Um, Coming to other assets, well, this is very simple. We just simply take this one. We have other asset here, and then we divide other asset by total number of revenues in that given year. That's it. For liability also, we have other liabilities here. We take liability and then we put it in terms of revenue. So we can simply that's it. So we have already now calculated the historical values for DCO, DPO, DIO, for other assets as percentage of revenue and for other liability as percentage of revenue. So I hope this is very clear. Now let's calculate the average DCO, DPO, DIO, and for other assets and liabilities here. We have to calculate the average. So that average will be considered for our future forecasting period. So for example, for DCO, the average number of days that a company takes to collect this receivable can be calculated like I type average here and then I select these 3 years historical values and then I close the bracket. So this is the average number of days that company takes to collect it is a receivables from customers. It takes 20 days. So we calculate average in the same way we calculate average payable days payables outstanding. To do this, I can simply fix the column here, and in the same way, both column and reference, I can simply copy paste this formula down to other years. That's how we can calculate it. To make it clear for you, uh, we can simply calculate average DPO, days payable outstanding. You select and you check here down. It shows you the average number of days or the average DPO we have here, which is 18 days. So I just automatically calculated using copy pasting formula. So if you see DIO, the average will be 26. In 2019, 24 days it takes to turn inventory into sales, 24 days in 2020, and 2021 it takes 29 days. That means the company is not improving. Inventory is not going out um, as expected and as it was in 2020. So it's taking longer days in stores to turn it into sales. So the average day uh, number of days that the inventory takes to be compared to sales is 26 days. So the projection will be the same for all 5 years, 26 days. In the same way, DPO 18 days for all forecast period, it is the same. So other assets in the same way, if you see the average is 2%, for other liabilities, average is also 1%. Yes. So this is how to calculate the average um, gross rate for this drivers of balance sheet projection. By using this rate, by using this projected number of days, we can calculate the forecasted amount. Here we go. To calculate the trade receivables, the formula is simply it's here. For projected trade receivables for 2022, we calculate the DCO, days sales outstanding, by a revenue in that particular year. This one we have already calculated it. We already calculate this one for, in a PnL segment. We already calculate this one. So we take that revenue and then we divide it by 365. In the same way, for projected trade payables for 2022, we take DPO, the one which calculated here, the one we have already calculated here, DPO, we take this one and then we multiply it by COGS of that particular projected year, 2022, and dividing it by 365 or 6360. Coming to inventory, we take DIO, which we have calculated by taking average, and then we multiply it by COGS in that particular year, and this is also from PnL statement, and then we divide by 365. Now let's go to our formula. Equal sign, I take DCO, and then I multiply it by revenue in 2022. I get this revenue from PnL statement, which is here, and it is this one. And then I divide this by 365. That's it. So I can simply drag this to the other years, and we have so many digital decimals here. One decimal digits. Okay. Coming to inventory also, as we have seen, we take inventory hit DIO 26, and then we multiply it by COGS. COGS is again from PnL statement. We are working for 2022. I click here, and then I divide it by 365. That's it. Make sure that it should not be in negative. It is becoming negative because we multiplied it with COGS, which was negative in our PnL statement. So to avoid this negative, I multiply it by -1. Sorry. So yes, I simply multiply it by -1. Now it's positive. That's it. Too many decimals. That's okay. So let's go to trade receivable equal sign. Which one we take for trade? We take DPO, which is here, and we multiply it by COGS. Don't forget, and COGS from PnL statement. We take this one, and then we divide it by 365. So in the same way, we have to make sure that it is in a positive term. So you can just copy paste the formula, because this formula is not complicated for you to do it. We have been working on it for something is wrong. Let me go back. Yes, it's not in the percentage. That's it. And what comes here, what comes next is other assets as percentage of revenue and other liabilities. It's very simple. Here we go. We simply multiply the projected percentage, which is 2% for other assets, by revenue, which is which will be in 2022, the projected one. It is this one. So you can see from here that how much income statement, balance sheet are interconnected. So we can do the same thing for other liabilities here, equal the total percentage for other liabilities, this one, the projected percentage grows. So I go for revenue, which is this one for 2022. Just drag it to the right for other years, and then that's it. So by now we are filling our projected balance sheet or forecasted balance sheet. We are left with PPNDE, cash, provisions, financial liabilities, equity. These are going to be done separately in the upcoming videos, financial liability also, but we can project or assume that the provisions a company assigns or set aside for unexpected events or incidents remain the same. So 8.7%, we can make it the same for all years. You can simply copy paste it to other all years. So that looks so good. So as I said, we'll be working on the equity section, financial liabilities, cash, inventory. Cash will be done after we prepare cash flow statement. After we finish working on cash flow statement, we'll be filling on cash flow statement. Cash projection in our balance sheet. All right, I think this is yes, it is a little bit complicated, but it can be understandable. Can be understandable. If you have any question, you can write on the comment section. By now we have already filled more than half of the balance sheet items. Yeah, looks good. All right, before we close it, you can see here that if I change the scenario here in income statement or in PnL statement from best case to worst case, it changes the projected amount or the forecasted amount in PnL statement. At the same time, it changes the forecasted amount in balance sheet here. So you can have something in your mind from here. For example, 167 million for 2022. This is trade receivable. Now I change the scenario to worst case in an income statement. Yes, it changed it already here. The revenue is gonna be like will increase only by 1%. And how much will be the trade receivable? It was 167 million. In the worst case scenario, the trade receivable in 2022 will be 164 million only. So it changes everything that we are working on the balance sheet when we change or switch the scenario here. So that looks so beautiful. Sounds good. Thank you for your time. See you with another video. Bye bye for now.